Hey, good morning or afternoon, depending on what part of the country you're in. I'm Jack Mannon, Director of Brand Marketing here at Builders FirstSource, and I will be moderating today's session. Before we begin, I have a quick legal notice I need to share from our legal and investor relations team. But before I do that, let me just mention we will have time for questions at the end, so please feel free to submit yours in the chat at any point during the presentation. So this slide is our standard cautionary notice regarding forward-looking statements. It simply means that today's discussion may include projections or expectations about future performance, which could change, based on a variety of factors. So with that covered, I'm going to hand things over to our President of Commercial Operations, Johnny Cope.
Thank you, Jack. Hello, everyone, and welcome to the second installment of our 2025 Home Building Market Intelligence Series with Zonda. On behalf of our Builders FirstSource 30,000 team members, I'd like to thank our incredible customers and our valued vendors that have joined us today. It's not surprising that we have a strong turnout. It's pretty amazing, but it's not surprising because, like E.F. Hutton, for the old people on the call, when Allie Wolf speaks, we listen. Thank you, Allie, for joining us today and sharing your outlook with us. Whether you build locally, regionally, or nationally, we know your time is valuable, and we appreciate you spending this time with us. At Builders FirstSource, our focus is very clear. It is all about our customer. Our customer is the bullseye of our strategic target, as you can see on the screen. If you're a BFS customer, we are committed to serving your business through investing in the infrastructure and capabilities that make building easier, faster, and more efficient. Those investments span across every stage of the process, from manufacturing and distribution to supply chain expertise, which you're going to hear from Jeff in a minute, and value-added products and technology that streamlines the way that you build and work. Our goal is to deliver a complete end-to-end solution that helps you overcome today's challenges and position your business for what's coming next, so you know you can win when we're working on this together. Today, we'll start with an update from our supply chain team, led by Jeff Reddick, our Vice President of Supply Chain. Jeff will share the latest on product availability, market dynamics, and what we are doing here at Builders FirstSource to ensure you have what you need to keep your projects moving. From there, as I shared, we'll hear from the rock star Allie Wolf, Zonda's chief economist, who will give us a clear read on the housing market and the trends that could impact your business in the months ahead. Thank you again for joining us. Jeff, over to you.
Thanks, Johnny. I'll try to live up to that. Hello, everyone. As we've all seen, tariffs have been in the news quite a bit this year, and everyone is trying to understand how it's going to affect their business and their upcoming projects. Here at BFS, we're keeping up with the latest news in an always quickly changing environment. Since February, we've been tracking the information on what products are impacted and to what extent. And as the situation continues to develop country by country, week by week, we'll continue to track the impact. Just in the last week, the final rulings on the countervailing duties were released. We're showing a couple of examples on how it will impact product from Canfor and West Fraser coming in from Canada. Now, please remember, anti-dumping and countervailing duties have been around for years, and unlike tariffs and the current exemptions from tariffs on lumber, these are in effect. The other noticeable increase recently announced is the 50% tariff on Brazil, as quite a bit of trim and plywood comes in from Brazil. On this slide, some of the current tariff rates on various countries and products are shown that are impacted, and some notes on products that are currently exempted from tariffs. As you can see, the rates vary quite a bit, from 15% all the way up to 50%. And just in the last day or so, as we talk about changing, it's been announced that the tariffs on China are going to be put on hold for another 90 days. Looking at forest products, OSB has continued to slide to levels we have not seen since 2019. With the DC ratios in the mid 70% range, the panel category is in an oversupplied state, driving downward pressure on pricing. We have recently seen some rolling curtailments from the mills, but most are reluctant to do any indefinite curtailments and official mill closures at this point. With prices being at levels below most mills' assumed operating costs, these decisions may ultimately be forcing some manufacturers longer term to make those decisions. Until production is lower to be more in line with demand, we could be in this pricing environment for the foreseeable future. The increased rate of the anti-dumping part of the softwood lumber agreement has been in place for several weeks, and the countervailing duty announcement just came out. With that, we're seeing mill behavior to be unexpectedly cautious in all species. That with tariff threats and discussions being less impactful recently, duty increases on that same Canadian lumber production has been the focus and the driver of higher prices here in Q3. Looking at the industry overall, we see supply in all lumber categories continue to outpace demand, and see buyers continue to swap species where possible to take advantage of price spreads that emerge. As manufacturers look to get supply and demand in a healthier balance, expect increased pricing volatility long term as we anticipate seeing more rolling shutdowns and future curtailments. If those actions do not stabilize pricing at sustainable levels, we could see extended shutdowns and permanent curtailments through winter and spring. Given these scenarios and dynamics, we feel that there will be less volatility in the short term as the market tries to find balance with supply and demand and the new duty rates. As we look at prices between now and the end of the year, we do expect volatility to accelerate as normal supply and demand dynamics get back in better balance. Some of the things that BFS is focused on: working with our partners, helping forecast our upcoming needs so that they can ensure that we have the products to meet your needs. When pricing is being impacted by tariffs, we're asking for verification as to what tariff is driving a change and to what extent. And as always, BFS is looking for alternative and viable substitutions to ensure we have the best product for your projects. Regarding building products and millwork, BFS has brought on inventory to help offset the volatility of the changing markets. The initial tariff impact so far has been highly concentrated in those categories that are solely or partially focused from China, such as hinges, doorknobs, hardware, stair parts, and door sills. In time, we do expect to see price increases in other products such as exterior fiberglass doors, interior molded doors, house wraps, cabinets, as well as some windows. Thanks everyone for listening. But now we're going to turn it over, as Johnny said, to the rock star of the webinar, Allie Wolf, the Chief Economist of Zonda.
Thanks, Jeff, and hello, everyone. I am delighted to be back here to go through the state of the housing market and wider economy. As I was saying to the BFS team before we jumped on this call, it's just wild how every time we get on these webinars, something has shifted or changed. You will see as I go through the deck, there are some similarities to what we had seen earlier this year, and there's certainly some things that are worth highlighting because of how they've pretty quickly changed in short order. Now, as mentioned, I am Allie Wolf, the Chief Economist for Zonda and New Home Source. If you're not overly familiar with Zonda, we are a housing data and consultancy firm. We track the entire building life cycle from raw land all the way up to the closing out of new home communities. Now, Zonda is our B2B side of the business, but we also have New Home Source. It's important for me to pause here on New Home Source because we have new data that is coming from this website that I'm going to show throughout the presentation. New Home Source is the #1 destination for new home shoppers. So if you go to newhomesource.com, you can see the example here. You can see different new home communities. You can book self-guided tours, use interactive floor plans and site maps. Because we own New Home Source, we can see all the click activity. Is someone looking for a 3-bedroom home? Is someone looking for a townhome, a condo, single family? Again, I'm bringing this up now so you can see the visual because we've now created indices off of this data that's helping us make sense of where the housing market might be going. Now, within my role at Zonda, I lead our economics department, which includes all of our published research reports. Our staple report is called National Outlook. National Outlook, even though it's called national, is focused on housing trends across the country. How is Charlotte different than Orlando, which is different than Columbus? We also have reports on building products, what's happening in the build-to-rent space, as well as master plans. Now, we have a lot to get through today. I have 40 minutes to go through 5 sections. We're going to start by doing a quick look at the economy. And I mean very seriously, about 2 slides, very quick, because we have so many things we need to cover when it comes to what's happening with for sale housing demand, what's happening in rental housing demand, what are we thinking about for the remodeling space, and then our final thoughts. So where I wanted to kick off today's presentation is with a question that I get on a pretty regular basis these days, which is, what is going on with the economy? And if you're asking the same question, you're not alone. There are so many mixed messages right now. If you look at things like incomes are growing faster than inflation. If you look at consumer spending, it's below where it was at the height of the market, but it's still positive. Stock market, sure, there's been volatility. If you look at year over year, year to date, 5-year trends, we've seen so much growth in wealth over that time. So these 3 items, if you looked at them in isolation, would make you feel pretty good about what the economic backdrop is. But there are some data sets that are at least expressing caution. We're going to talk about housing starts later in this presentation and why they matter, but housing starts are slowing, and that has economic implications. And think about inflation. We did get the inflation read yesterday. We know that that is going to make the Fed hopefully feel a little bit more comfortable with a cut come next month. But inflation's not back to the Fed's 2% target. There's still risks related to whether or not it's inflation from tariffs or it's just a higher level of prices over time. We need to pay attention to that. While we have these good signs in the economy and these signs that are, hey, at least watch us, there's also some fairly negative signs in the economy today. Consumer confidence, it's improved from where it was in April or May, but consumers don't feel great about what the next 6 months look like in the labor market. We'll talk about that in more detail on the next slide. If you were to ask me to describe the economy in just one phrase, I think the easiest way to say it is that we're in a slowing but growing economy with what I would say are increasing or mounting risks. Let's go to the idea of the labor market though. So for those of you on the call that are directly involved in for sale construction or rental construction, the labor market is the most important indicator we need to pay attention to, because this is a very reliable demand signal from both for rent and for sale. And unfortunately right now we are seeing that it's flagging a little bit. I don't want to get into, do we trust the data or do we not trust the data? The general view is that the economy has slowed. Businesses are not hiring as much. Businesses are not backfilling positions that they let go to the same extent in the past. So however way you want to cut it, we do have slower overall job growth. But specifically, that national number can give you a directional trend. It can't tell you about local dynamics. That's where you have to take the data and say, okay, well, what stats do we care most about? In particular, for sale housing, we want to pay close attention to high income job growth. If you're seeing continued levels of high income job growth, you should, all things considered, feel better about what the housing market might look like in a given area. Now, right now, 50% of the top markets have now seen their high income job growth turn negative year over year. Generally speaking, as you look at this map, you want to be in an area that has a darker purple dot versus lighter. Lighter will be more flat to negative high income job growth. I want you to notice the Carolinas, Raleigh, Charlotte, Myrtle Beach, Charleston. You're going to see some consistent trends in the Carolinas throughout today's presentation that set that area of the country apart from other areas. But generally speaking, we're seeing trends are slowing. We also like to look at not just that year over year change, but what about markets that have faced a notable deceleration compared to the prior year? Now, Sarasota does still have positive high income growth compared to last year, but look at how much the market has shifted. High income was growing almost 4.5% last year. Now it's at 0.5%. As you look down the list, Las Vegas has turned negative. Jacksonville negative, Houston, Dallas, Lakeland. These are some of the top markets that have decelerated. But on this list, these are also very big production markets. So we're paying close attention to these because they can have outsized impact on what happens with overall housing starts. Despite the fact, or really besides the fact, that when we look at employment, it's a reliable demand signal, we also care about employment because we're seeing more cancellations at new home communities because people are losing their jobs or feel uncertain about their jobs. And think about our big issue, affordability. Well, if we now start to have more people that are looking for jobs and workers don't have as much negotiating power on their wages, we're not going to see as much affordability relief just from people being able to bring in more money each month. We're in an environment right now, though, where bad news, so bad news being the labor market is slowing, we've seen some revisions to past months, ultimately becomes good news in some aspects. The key aspect here is mortgage interest rates. Whereas we've looked at the trend since the end of April of this year up until a couple weeks ago, we were consistently talking about interest rates in the high sixes, low sevens. We're still talking interest rates in the sixes, but now depending on the day, we're looking at mortgage interest rates, the 30-year fixed, between kind of mid sixes to high sixes. So that's an improvement from where we are. If you look at the blue line, you'll see a little bit of an uptick in the most recent week. That corresponds to the inflation data. The fact that it wasn't getting closer to 2%, you saw a little bit of an uptick, but still our trend right now is we have interest rates at the lowest point we've seen since April. But if you extend that out further, you're looking at the lowest rate that we've seen since the end of 2024. So not great. Affordability is still going to be an issue with interest rates in the sixes and home prices where they are. But I think, again, going back to bad news becomes good news, that is a positive sign that's coming out of some of the messiness in the wider economy. But now let's then transition the discussion to housing. So the first place I want to start is with existing home sales. I almost always do this because it represents the largest share of transactions. Purple line is 2025. Your key takeaway here is whether you saw me 6 months ago, 12 months ago, 18 months ago, 3 years ago, we still have the same story. We're in an environment where existing home sales are still weak. We're still just bumping along the bottom. What has shifted throughout this year is while we have a weak existing home market, we have a weakening new home market. Purple line is 2025. Where we are right now, down from where we were in 2024, down from where we were in 2023. I want you to look at the chart on the right and look for that mint color line. That's 2022. The conversations we're having with builders, they would tell us that it feels exactly like what it was in 2022. Overall sales don't actually align with that. And I think what's happening is what we've talked about in the past. Builders are saying, okay, the problem is we don't have that much demand, or the demand is skittish, and so we're really just having to throw the kitchen sink at the consumers to get them to go through with the purchase, which is why it feels more 2022 like another point in time where we had rising interest rates or higher interest rates and economic uncertainty. Now, we talked about this last time we met, that at this point, if you go into a new home community, you basically will expect, and consumers do, that there's going to be some kind of discount available to you. Maybe it's going to be a design credit, maybe it's going to be funds towards closing costs, maybe it's going to be a price cut. What we see on New Home Source is price cuts are increasingly common across the country, where builders are advertising, hey, we used to sell it for this price, now you can buy it cheaper. That does correspond with what we're seeing with closing prices, where nearly every market across the country has now seen closing prices go down. When you see headlines, try not to be shocked. There's some organizations that are trying to really make a lot of attention by saying prices are down. This is kind of old news at this point. There's some markets that prices are already down 20% from where they were at peak levels. This is kind of par for course to be able to get homes to sell today. But I want to pull something that if you follow myself or my coworker Brian Glasshagel on LinkedIn, this is a thought experiment that Brian did recently. Brian's our Texas expert. He's in our advisory team. And he basically said, if we know incentives are common and we know price cuts are common, Which one makes the most sense financially from a builder point of view? So a little bit of context, we do a survey with builders every month and we ask builders to what extent are they buying down mortgage interest rates. We said interest rates today are averaging between mid sixes and high sixes. The majority of builders are saying they can buy down the rate between high fours and low fives. So if we just take a $500,000 home, let's say the builder is willing and able to do a buy down, they're dropping the interest rate from 6.75 to 4.75. By the builder offering that buy down, that is a $500 per month saving. That's huge for a lot of consumers that are grappling with affordability. Now, to get an interest rate from 6.75 to 4.75 is not cheap. That is going to cost the builders, we're estimating somewhere between 8 and 10 points. That translates to a 32 or 40,000, somewhere between there, cost to the builder. So, okay, we want to bring the interest rate down. That's going to cost us $40,000 to be able to do that. On the flip side, what about if they were to do a price cut? Now, this to me is astonishing. If you want to get the same monthly payment impact, meaning reduce that monthly payment by $500 per month, the builder would have to drop the price by $100,000. So this is why, as we talk about incentives and we talk about what builders are offering, why those buy downs become really important. But from a consumer point of view, they're not paying attention to the cost to the builder. They're thinking about, am I buying at the top? Do I need to be careful about what price I pay? And that's why we generally see the two of them coming together versus one necessarily happening by itself. But let's go back to new home sales. We said new home sales are weakening. We tracked out that they're down compared to where they've been recently. We then take those new home sales, adjust it for supply, adjust it for seasonality, and rank each market relative to itself solely based on sales. So we say, okay, in Indianapolis, how do new home sales look compared to what Indianapolis has been selling since 2015? Now, as we look at this, you can see nationally we have an average market, which means it's not abnormally slow, it's not abnormally strong. You can see the yellow dots are average, red are underperforming, green are overperforming. Now, what I'm going to say is quite obvious, but let me explain why. I am much more nervous today about markets that are red or yellow because these are markets, really everywhere across the country, that builders are rolling out the red carpet for consumers and consumers are still not showing up. Those are the markets you need to say, well, why? Why is Dallas still average? Why is it not overperforming if builders are cutting prices and offering incentives? And we know that a lot of this comes down to economic uncertainty. We'll talk about other reasons why consumers don't have much urgency a little bit later in this presentation. But now let's talk about the future. So what I'm showing you here, the Zonda market ranking, is based on contract sales. Someone has gone into a community, they have signed a contract, I want to buy that home. What we can do, and what I teed up in my introduction, is we can also look at people that are just browsing. People that are saying, I'm not ready to go into that community yet, necessarily, but I live in Charlotte. What new homes are available? What can I afford? Do I like the product? Do I want to go see any product? We're looking at internet search activity on New Home Source. And what we're finding is right now, clicks are down about 6% compared to where they were last year. As you track this out, you can see November 2024 was a slower period of time. But generally speaking, this is telling us that we shouldn't expect that demand is just going to pop up out of nowhere. We don't have that many consumers that are getting their ducks in a row that are actively looking for new homes, at least nationally. But this is where national trends, and this is a consistent theme throughout my presentation today, but really all of my presentations, is national only gets you so far. So now what we're doing is we're taking a look at all of these markets across the country and we're saying, okay, based on search activity on New Home Source, this is all available in a new report that we just released. We wanted to say, what markets are we seeing consumers be most active and least active? And what becomes interesting about this is if you look at California, for example, California home sales have not been great. The market does not feel particularly good, but there's a lot of people looking for new homes in California. To me, this says they're saying, okay, if interest rates come down a little bit, or if I feel a little bit better about the market, I feel more likely to go into a community. I've done my research. I know where I want to go next. If you look at some of our higher production areas that are making the national news for being slower housing markets compared to where they were, parts of Florida, Texas, the Mountain West, for example, you have consumers that are, it's probably a sentiment issue, that are just saying, hey, I don't know how much I want to buy a home today because it just feels like things are still a bit uncertain. This ties to the key phrase to describe the market right now, which is there's just no urgency. As we talk to builders, we have 80% of builders right now that are saying demand is slower than expected. Very high percent, 60%, saying demand is slower than expected and causing concern. Look at how that shifted. You had 20% of builders saying the market was concerning in January, and now it's up to 60. Makes sense though. If you think about the question of what is going on in the economy, it's not just us, it's everyday people that are not involved in our space that are still saying, is the recession on? Is it off? Is my job safe? If I lose my job, can I get another? Tariffs. Tariffs do not happen in isolation. People read about tariffs. People are saying, is this going to impact my pocketbook? Is this going to make things that I buy more expensive? That's leading to people not having that much urgency. Affordability, a little bit of relief. I will say I had a coworker that has been sitting on the sidelines. They did not want to buy a home. They saw interest rates went down and now they're under contract. So there is a little bit of a relief, the fact that interest rates have come down from where they were, but this is still going to be a big issue for us. And the fact that consumers now have more options. Think about the backdrop. Where we have been is consumers are saying, if I want to buy a home, I should buy it soon because there's not much inventory on the market. And if a good home is on the market, I don't want to lose it. Well, now that still applies if you're in parts of the West Coast, parts of the Midwest, parts of the Northeast. But if you're in Texas, if you're in Florida, if you're in Arizona, if you're in Colorado, Utah, what's the rush? There's now more inventory that's available, and so consumers can take their time. It's not only that consumers now have more options available to them, they have more competition. And this becomes an issue for the new home market where builders have, okay, I have a move-up consumer that wants to buy a home, and because I'm buying down the interest rate, they're not concerned about resetting their 3% because I can buy down their interest rate to 4.5%. The consumer then goes to list their existing home on the market, but their home is taking longer to sell than they originally thought, and maybe they're not getting the price that they originally thought. And so it's just creating this complicated market and almost a bit more normal, something we would have seen in 2018, 2019, but not something that we've dealt with in years at this point. So we know that in general, existing home and new home inventory is rising. One of the ways we like to look at new home inventory, though, is through community count. Community count is anywhere where there are 5 or more units for sale, and Zonda tracks this across the country. Now, what we've seen with community counts is we've now had 6 straight months of there being more communities opening versus closing across the country. Go back to my theme. This national data only gets you so far. Nationally, we are operating with far fewer new home projects than we had in 2019. If you're in parts of California, we have 50% fewer actively selling projects. There's just not much new home competition. If you're in parts of Florida, yes, there's been a lot of migration. Yes, there has been employment changes, positive employment changes over time, but you also have 50% more actively selling new home projects than what we've seen in the past. So what we wanted to get a sense of is, all right, 6 consecutive months, community counts going up. What's going to happen as we finish off this year? 33% of builders are saying, okay, it's going to be about the same, their community count compared to last year. You can see that we're looking almost 50% of builders saying, well, we think community count's ultimately going to be up compared to where it was. This is interesting because there's been discussions of, well, if the market is slower, aren't builders just going to pull back? They're not going to open new communities. Well, 9% are saying, yeah, we're going to just slow new community openings. 13% are saying, let me watch. If the market gets worse, we'll probably need to slow our openings. Almost 80% say we still need to open the community, but we can control one thing. We'll open that community, but we'll curtail the number of specs that we offer. So that means you're going into a community, instead of having all the specs that we know consumers to a certain extent want, We also know this has been more of a risk to builders, and so they're saying, well, let's just do fewer starts per community for the balance of the year. Let's get a better sense of where demand is before we get aggressive on more construction. This will come into our single family housing starts forecasts as we go later into the presentation. Now, I want to turn the discussion now to the rental market. And the key thing with the rental market is that there's a lot of good and also a lot of bad. There's still some things that we need to work through. But on the good side, when you think about rental, part of the reason we're not seeing for sale demand as strong is because people have options. And in the past, people would say, okay, I'm willing to put a little bit more towards buying a home because I understand that if I buy a home, I'm investing in myself, I'm building wealth over time, nest egg, etc. What's become an issue is it's harder to be able to justify that discussion when owning is so much more expensive than renting, at least nationally. We know that this has been a factor that has kept demand strong on the rental side, which we'll talk about and we'll show some stats a little bit later. But remember that one of the biggest challenges in the rental side right now is supply. So from the new home point of view, as demand was strong over the past handful of years, builders could bring homes to the market pretty quickly. They could respond to the market, as quickly as they could. On the apartment side, it was more because these units all get delivered at once. We got to a point where there was not enough apartment supply to, oh my gosh, there's a lot of apartment supply that's been delivered in really short order and concentrated in certain parts of the country. So the good news is we're past peak deliveries. This is new apartment supply. You can see where we got to at the end of 2024. We're not seeing as elevated, although it is still higher than most points we've seen going back to the year 2010. But it's not just that we're past peak deliveries. We also now need to continue to work through those units that were delivered. Now, I want to read this directly from my coworker. We have a multifamily expert. Her name is Kimberly Byram. And Kimberly put together this chart of the fact that there's been an absorption lag. Lots of new units being delivered, not that much demand. What is going on? This chart is showing new supply from previous years that have not been absorbed divided by total units entering the market. Put a different way, new construction plus overage from previous years. So in areas like Greenville, South Carolina, you can see Jacksonville, San Antonio, Atlanta, Raleigh. These are some of our big production markets. They're also ones that there's a lot of supply overhang right now, where you historically should see this be 0%. You can see Houston and Miami are there. You should not have excess inventory. Right now, we do have excess inventory in certain parts of the country. Again, our theme, blanket statements, can't make them, because there will be areas that it feels like supply is a lot. There's a lot to work through. It's a frustrating rental market right now. There's other areas where developers would say, what are you even talking about? Look at the markets across the country here that have a darker purple dot. Generally speaking, for occupancy, we want 95% or above across the West Coast, across the Midwest, across the Northeast. These have been pretty consistent trends that these regions in the rental market have performed better. In some cases, it's because of demand. In some cases, especially along the coasts, it's just hard to oversaturate the market. So we're still seeing that supply is tight there. But as you look at our higher production, we also call them higher growth. They were areas that people very rightfully moved to during the pandemic for employment reasons, affordability reasons, weather reasons, whatever it may be. That's where we're finding the most competition. That's where we're finding occupancy the lowest. That's where we're finding rents that have turned negative. This map is only showing you top markets where rent growth is down year over year. So again, very much aligns with where we're seeing the most new home supply, where we're seeing the most resale supply, where we're seeing the most rental supply, where we've seen a lot of growth, but almost a mismatch. It's not only that, but we're also finding concessions are going up. Not every project is offering a concession. A concession would be 6 weeks free, something like that. Where not every project is offering it, but as time has gone on, we've seen concessions go up. They used to be at 8%, which I think is 2 months free. Now they're 9.3 as you look across the country. But this goes back to the differences. You still find kind of the coasts being the exception, West Coast and the Northeast, plus the Carolinas. Remember, we talked about the job growth there. This is where you're seeing rents that are rising. In parts of Florida, it can be base effect where rents had come down a little bit last year and you're seeing a little bit of growth. Part of it can just be like in Miami, like I said, very hard to oversaturate a market like Miami that is landlocked and hard to get too much supply there. But as we go back to this and we say, okay, we know that there's markets that have seen rents go down and are still seeing rents go down, but this map is showing you markets that are seeing rents go up. And that is actually quite notable across the country. We know demand has been strong. This is what is making the rental market pretty complicated to understand. The first quarter demand was the highest first quarter we had seen since the year 2000. The second quarter demand was the highest second quarter we've seen since the year 2000. The challenge is, yes, there's a lot of people that want to live in rental communities, but we also know that there's a lot of supply, and that's why we're finding that mismatch in some areas. If you think about apartment demand, though, know that there's a couple other ways to look at it. So this is showing net apartment absorption, so space vacated versus space leased. We know that there's not many people that are moving out of a rental to buy a home today, given economic uncertainty, given higher interest rates. We also know that retention is still high. So people that were living in apartment communities are continuing to live there. They're renewing their lease year after year. Now, I want to change the discussion to move into the remodeling space. And for this, I can't give too much detail away. Todd Tomalak, he's our building product expert. He's amazing. He's one of the smartest people in our industry that you will ever meet. And he has a report called Building Product Outlook, where he just released, I think it was a 40 or 50 page report on his latest forecast. I can't go through too much of that, but I do at least want to give you his high level forecast and his high level thesis. So as Todd looks at the market, one thing that I should have said on rental is we still think it's going to be choppy. We still think it's going to be challenging. I'll show you our multifamily forecasts in the next section. But very similarly, Todd is saying that for remodeling, we should expect it to be challenging for about the next 9 months. Now, Todd, as many of you know, he has called this the golden decade for remodeling. He thinks there are so many reasons that remodeling is going to make a lot of sense, but there's some hurdles we need to get through between now and then to be able to really see that play out. Now, one thing Todd said is we're not actually as concerned about the lock-in effect as we've been. We've seen as time has gone on, as people run into lifestyle changes, they will reset their interest rates. We know that because builders do buy downs, there's different consumers that have reset their rates as well. It's still going to be a backdrop. It's still going to be lingering. People with a 2% interest rate are really going to be hard pressed to move. But what Todd says we're in right now is this uncertainty-driven deer in the headlights. I will say this applies to me 100%. We have been planning to do some kind of remodel to our backyard for a long time, and every 6 months we go to reevaluate it, and the market is still just like, do you want to spend that cash or do you just want to wait a little bit? So I can very much relate to this deer in the headlights thesis that Todd is saying about today's market. So Todd takes this. He breaks out all of his remodeling forecasts by different category, by different input. The two, though, that I'm going to show you here is just Todd's forecast on spending growth on building products in 1, installed on new homes, and then 2, installed on existing homes. So this here is showing you spending growth on building products installed on new homes, where Todd did have to bump his forecast down. He originally had this 130, well, we're down 130 bips from his original forecast. He's calling for an 8% decline in spending growth this year. As we go into next year, I think he's had to lower this forecast down as well. So now he's calling for 4.4% drop in new construction spending, partly because of the environment that we're in right now with slower housing starts. That's going to play into next year when you think about the building products going into those homes. Now, the other way he's looking at it here is that spending growth on building products installed on existing homes. Here, he did also have to lower his forecast for this year. You can see next year, he's calling for 7.3% growth. He thinks that related to deer in the headlights, people like me are choosing to defer our improvements versus completely stopping them, which is going to just cause these delays that can lead to a little bit of an uptick once we feel a little bit more confident, a little bit more certain about what's happening with the tariffs, what's happening in the economy as we go into 2026. You can see positive growth going into 2027 as well. Now, at this point, I want to finish the discussion by talking about our single family starts forecast, our multifamily forecast, and then just kind of our broad thesis on the market. So the first thing that I want to start with is, if you've seen us forecast, we obviously originally thought the market was going to see an improvement year over year. That was backed by what builders were saying, by the builder sentiment. And as every month has gone on this year, we've seen builders get increasingly more cautious, to the point of our July builder survey now showing us 70% of builders anticipating starts to be flat to down. If you look at the far right of the chart, this is only going through April. It would be higher if we went to January, but we had about 25% of builders that thought starts would be up more than 10% this year, and now we have that down to just 9%. Because sales are down, starts will be down. It's almost as simple as that. This is looking at our Zonda data where we compare out starts and closings. Really ignore the pandemic years. Those were just odd years for a whole bunch of different reasons. Look at 2019 and then look at the data more recently. We're seeing that healthy and an important alignment between starts and closings. If we will sell homes, we will build homes. If we will not sell homes, we will not build homes. Because of this, because of how builders are viewing their current standing inventory, because of how they're viewing current demand, because of the future demand, like I said, if you're looking at click activity, how much traffic is happening right now, we did have to bump our forecast down again. So where we are right now, single family starts down about 12% compared to last year. I had mentioned this earlier in the economy section, but what becomes important is traditionally when housing starts slow, the economy slows as well. And that's because for every home we build, we create 3 jobs. For every home that is sold, there are so many related companies and business and people that can benefit from the point of sale and from someone moving in and wanting to furnish the homes or wanting to do some remodeling. We do think there's some broader economic implications with single family housing starts coming down. But I would say one really positive thing that we're seeing in the market is that there is a lot of builder discipline. We feel really good that builders are being reactionary, which in some cases puts us in trouble when demand comes back quickly or if interest rates come down quickly. But the way we're viewing it is, yes, there's some markets right now where supply feels really high and builders do not feel comfortable about what it takes to sell those homes. But I also think that because of our reactionary tone in the market, we're not going to see any blatant or long-standing new home for sale construction buildup. That doesn't mean short term there isn't, but we don't see this looking similar to some past cycles that we've seen where it's like, gosh, what are we even going to do to be able to sell or move any of these homes? But remember, when we think about housing starts, housing's local. So Zonda tracks what is happening with housing starts across the country. This is showing you the top 25 production markets. As you look at the year-over-year change, we shouldn't be surprised to see that the majority of markets now are seeing that starts are already going down compared to where they were last year. You can see some markets coming in as flat. Dallas still the largest production market, but not much growth compared to last year. Charlotte's another example. Indianapolis basically coming in as flat as well. Now, when you look at what is happening with housing starts, I want you to remember that idea of starts and sales being aligned. We know that sales, generally speaking, are above where they were pre-pandemic, above 2019, and yet there's some markets that actually have starts below 2019 levels. To me, this chart really gives more questions than answers because you have to say, well, is it because there's too much supply? Is it because demand has pulled back? Is it because of land issues, regulation issues? I think there's a lot of things to unpack here, but generally speaking, we're seeing the market shift, but it very much will depend on what local market we're talking about. Now, if we go back to the multifamily space, I'm kind of using multifamily and rental interchangeably. We know that the multifamily data is typically quite volatile from the census, so it's hard to call it exactly right, just given the wild swings in the margin of error. But generally speaking, we've seen starts come in below 400,000 since where we were in 2023. We do expect that the next couple of years, we still think multifamily will be slow, looking at the mid 300,000s here. The reason we're not seeing more aggressive building comes down to a lot of the things that we covered today. From a developer point of view, if rents are down, you're not going to feel that enthusiastic to go aggressive on new construction. If inflation might go up, the total cost to build might go up, that becomes a concern. What about access to the labor force? Are there any changes in the construction costs related to labor that could play into this? Interest rates, a huge factor that plays into the rental space, plus the fact that there still is some of that supply overhang. So as you roll it all together, it kind of makes sense why there's just not this full steam ahead mentality. But I will tell you from our multifamily practice, there's more enthusiasm. We're hearing more of like, okay, the worst is behind us, and now we need to start thinking about what the future looks like. As I finish here on my last slide, we're doing our best we can to understand the market, the changes, the dynamics, just all of the moving parts. Our base case goes across a bunch of categories. Consumers, we think consumers are going to continue on the sidelines. We think that lack of urgency is going to hold. If we see interest rates come down more and the economy look okay, we would feel better about demand coming back out. If we see interest rates come down because people are getting increasingly nervous and companies are continuing to cut jobs, I'm less enthusiastic that we're going to see this immediate positive response from consumers. We think sales, they're going to remain stagnant on the new home side. We think the risk is to the downside that maybe they slow even more. We will see further price adjustments like we've already seen play out, that builders will probably need to lower prices a bit more to be able to move product. Existing home sellers will have to be more realistic about what the backdrop looks like. We talked about increasing supply. There's no way around it. This is very, very different than the past 5 years. But like I said, we're expecting more of a return to normal, no glut nationally, but remember to pay attention to this locally because it does feel like in some markets there's a glut of supply that needs to be worked through right now. We don't see a foreclosure crisis. We feel like the loans that were made were very sound, very strong, good economic backdrops. But if people lose their jobs and they bought their home more recently, you probably will see some forced sales play out in the market. Rental, we talked about this. Working through backlog, still choppy, but signs of healing. This is the first time in a while that we're hearing those signs of healing and we're seeing a little bit more optimism about the market. Job losses. What I would say, don't take this politically. As an economist, I trust the data sources that we are given, and we are seeing enough evidence, even if you don't like the BLS, if you don't trust the BLS, fine. But there's enough evidence from other data sources, from earnings calls, from businesses that tell you that the labor market is shifting. We do think we could see overall job numbers turn negative over the next 12 months. Recession, I know economists have really lost any trust from anyone on our ability to call recessions because there have been so many moving parts. Our odds are 40-60, so 40% yes, 60% no. My biggest thing here that I'm trying to say, okay, when would I change these odds? When would I feel like the risk has shifted more towards recession? Is if consumers feeling uncertain start to actually profoundly pull back on what they're spending. Right now, they don't feel great, but they're still spending. If they don't feel great and they stop spending, that's where this forecast is going to get thrown out the window, and it's going to be a different backdrop. I mentioned our national outlook report. We laid out our base case, but also best case and worst case in that report of, hey, things could get a lot worse than what we're forecasting here, or things could be a lot better than what we're forecasting here and how we think it might play out. So with that, and with 10 seconds to spare, Jack, let me turn it over to you for questions.
You bet. Thank you, Allie. It never ceases to amaze me how you're able to get through that much content right on the money every time. 40 minutes. Incredible. Okay, let me go through a couple questions we've got here in the chat. First question's come through several times. Will there be a copy of this presentation? Can I get a recording? Absolutely. We are doing our best to get this turned around by tomorrow, if not by Friday, so everyone can have access to the information shared. All right, next question. Here's one for Mr. Reddick. Jeff, beyond what you covered on the tariff and duty slides, do you see any additional product concerns we should be aware of? For example, roofing. Are there any products currently on allocation?
No, with the supply demand, with definitely supply outpacing demand on almost all products are readily available from what we're seeing. The only concerns I think we have right now is with some of the tariffs that are being impacted, like we talked about with Brazil, that could possibly impact the trim and plywoods coming from Brazil as people start to scramble to secure alternate product from other countries. The other one would be secondary impacts. If we see steel on China go up, we're seeing prices on steel in the United States go up, and manufacturers that use steel, we're seeing increases on that. So it's kind of a wait and see right now, Jack, but we are watching.
Terrific. Thank you for that insight. Here's one for Allie. Allie, there's often confusion about how the Fed's interest rate decisions affect mortgage rates. Can you walk us through the connection and how Treasury notes fit into that picture?
Yep, this is something that I put in my presentations on and off, and then I think people get sick of me talking about it and I take it out. And then things like Fed rate cuts are coming back up in discussions, and so now everyone wants to know again. The first thing you need to remember, and I think the best way to exemplify this, is that the Fed does not directly set mortgage interest rates. If you think back to, I think about a year ago now, the Fed cut short-term interest rates, which is interbank lending, it's the federal funds rate, and mortgage interest rates went up. So do not be surprised if you see some kind of weird, well, I thought the Fed was cutting rates, so why are interest rates going up? It's ultimately that investors of 10-year treasury yields, investors elsewhere in the economy are placing their money and placing bets based on what they think is likely going to happen in the economy, what is going to happen with the Federal Reserve, what is actually playing out today. Investors can be influenced by, like I said, inflation report comes out. The Fed hasn't done anything different, mortgage rates went up. Jobs report came out. Fed hasn't done anything different, jobs report didn't look that good, mortgage interest rates went down. Generally speaking, lower interest rates correspond with a slower economy because what that's intended to do is try to stimulate growth. So I'd say don't root too much for interest rates to come down because it usually means there's some other issues that you need to pay attention to. But seeing a little bit of compression or movement here and there is because of investors, not because of the Federal Reserve.
Sure. Thank you for that clarification. Okay, another one here. If the Fed cuts rates by 50 or 100 basis points, what does that unlock in terms of single and multifamily housing starts?
I think for single family, it's not as easy to give an answer because it's going to depend on how much does the mortgage interest rate come down? Are consumers happy that the Fed is lowering rates? There's going to be too much of the human psyche from the single family side to give a direct answer. From the multifamily side, we talked about the healing in the rental space. One of the big things that multifamily developers will say is, I just need that 10-year to come down. I just need to have lower interest rates to make my deal pencil. I think you would see more positive lift. You'd see more of those investors that are feeling better say, okay, now it feels like we should probably be getting going on pre-development. I think multifamily stands to improve more notably.
Here's a question. As you know, everyone on this call is doing their best and working towards making housing more attainable. How can BFS help us become more efficient?
All right. So there's various ways, Jack, that we can help with that. One is the products that we're purchasing for our suppliers or our builders out there. We're looking for the most economical solutions, but it also goes back way to the design phase. If we can bring in Paradigm to help design the project so that it flows a lot smoother and easier, we can take a lot of the build time out, as well as we start looking at the value add components that we've got within BFS. If we can put in wall framing, ready frame framing, various trusses and installed labor out there, we can help take downtime out of a job and help improve efficiency along the way. So lots of different things that BFS can bring to our builders.
I see one, Jack, on standing inventory. Do we want to go through that?
Yes, let's do that one here. Okay, reading that one out loud. Standing inventory, how long will it take to burn through it?
Okay, so some of you heard that I alluded to the idea that there is more standing inventory. We call it quick move-in inventory in certain markets across the country. So I want to use a couple examples. I just did an event in LA where I think there was 1.5 quick move-ins per community. In that case, you don't have builders that are like, oh my gosh, there's so much standing inventory, I don't know what to do with it. That's for the LAOC metro in general. But if you look at somewhere like Phoenix, there's 5 quick move-ins per community where the dynamics are very different. That's when the price cuts come in, the aggressive incentives. We've heard the phrase, I think, like a knife fight, where it's just like, how do you sell these homes? What do you need to do? How are you gonna get that product sold? I think what's different is than past cycles, perhaps, is that as builders work through that standing inventory, some of them have a business that's just more spec or more QMI to begin with. But for other builders where that's not the basis of their business, they're saying, okay, let's sell through these homes and now let's be really cautious. Let's not backfill it. So that's why we're seeing some of the starts come down, but it's also, to me, a positive reason to believe that we're not going to be still working through the standing inventory 12 months from now, for example.
All right, I think that's going to bring us pretty much here to time. Just again, thank you everyone who took time out of their day to join us for our second Market Intelligence webinar of 2025. There'll be another one coming up here in the fall time. And please keep an eye out for a copy of the recording as well as today's presentation.
And thank you, Allie. Thanks.
And thank you, Allie. All right.
Thanks, everyone.
Thank you and have a wonderful rest of your day.